Hi, my name is Alex Carlucci with Gustin Cho Associates at Loan Cabin. I'm going to talk to you today about student loan debt. A lot of you guys have that out there and how it affects your loan qualifications and how we have some things that the guidelines allow us to reduce your debt. But let's go first start with what underwriters are going to use at every bank out there. So for a conventional loan, if you have $100,000 in student loan debt and it says zero payment, they're going to use 1%. So that'd be $1,000 a month payment. So it's a pretend payment. You're not going to make it to the student loan company, but we're going to hit it on your debt to income ratios. And FHA is also 1%, even if it has a payment, unless that payment pays that more debt off in the time frame that's left. So if you have a $100 payment for 100 more months left on your payment, and your student loan debt's $100,000, the underwriter's not going to use that because that's not going to pay that debt off in the time left on your student loan. So if it's less than the amortized payment, then they're going to hit you for 1% also. And VA is going to do this. They're going to take your total student loan debt if you have a zero payment on it, or it doesn't amortize out. They're going to take 5% of it. Let's say you have $100,000. 5% of that is $5,000. They're going to divide that by 12. That's about $420 or $430 a month. And that's how VA looks at it, that's how FHA looks at it, and that's how conventional looks at it. Now, if that payment is too high and you don't qualify, we have investors here at Loan Cabin that will do a different thing that saves people on their payments and gets them to qualify. So if you're a 56.9 DTI or 58% DTI, you need to get down to 56, we have a few things that you can do. Let's start off with conventional. Conventional will allow you to call the student loan company and they will let you do what's called an income-based repayment program. Now there's also an income-driven payment program, there's an extended payment program, there's graduated extended program. You only can use the income-based repayment program. It's called IBR for short. So if you do that and you give them your income and they'll calculate it. If you make $100,000, don't think that they're going to not give you a good price. They will. It's not like they really price it on how much you make. It is priced on how much you make, but they still give you a better deal than 1%. So call your student loan company. You have to get an IBR payment. You have to agree to it, and you have to have an initial first payment due date. So you can't just get an estimate. We can't use estimates, and this goes for all the programs. So you have to actually execute the loan. Let's say your first payment's due June 1st or whatever. So you'll have a payment. Once you have that document, we can use that payment for your student loan debt for conventional. And what you're going to find with these student loan companies, they're very friendly. If you want to go back to deferment or zero payment that you were at and not continue to make those payments, you can call them up and you can do that at any time. 6 months down the road, you can call them up and go back to deferment. So don't be feeling scared that you're stuck to that payment forever. So that's conventional. IBR, we'll use the payment. It's less than the 1% that the underwriter is going to use at most lenders. For FHA, you're going to do what's called an extended payment program. And you can't do the graduated extended. You got to do the standard extended, and they'll extend it for 25 years. Most student loans are amortized right now over 120 months, which is 10 years. This will extend it to 25, reducing your payment in half usually. That's roughly half of 1%. So if they're going to hit you for 1% at one lender, you come to us, it's going to be about half of what you're paying now, what they're going to make you pay or pretend to pay at another lender. So you're going to call them up, just like you did for conventional, ask for an extended payment program, and you're going to start it, you're going to execute it, and we'll use that payment for FHA. So that's how FHA works. And now we're going to talk about VA. VA has only one trick, and that is basically if your payment is deferred and it says zero payment on there, we can use zero only if it states on there, or you can get a document from the student loan company that it's deferred for at least 13 months. If your student loan is deferred for 13 months or more, we can use zero payment for VA. So those are the three major student loan tricks that we have here at Loan Cabin. So give us a call. We can close these loans. I do it all the time. And please like this video if you like it. And if you got any questions, please give me a call. And thank you very much.